binary, meaning it's not really an either-or question, it's really how and when to complete the project. Also an important point is that the incorporation of IFRS is not inconsistent with the SEC maintaining the ultimate rule. And actually just recently there was a joint announcement from the chairs of FASB and ISB stating that the FASB is not going to set aside after the so-called endorsement approach is completed in the standard setting process. So it's really hard to argue with the first statement that the objective would be to get a set of high quality global standards out there, and it would really help a lot of companies, again depending on the industry and depending on the scale of their operations, especially in comparativity purposes. And there are some international companies in the US who are really encouraging this, because if they have international competitors, it might be a lot easier for them to compare their results. There are some, however, on the other side that argue that the US financial reporting system is maybe more sophisticated. There's a lot more disclosure requirements under US GAAP. There's a lot more specific industry guidance, and we'll get there too, mentioning a few examples in the next report. But the primary objective based on this staff paper would be to have these high-quality global standards. This staff paper received some comment letters. Again, just tying back to the points I already said, that some say that endorsement would be something worthwhile trying, especially it might be a way to reduce the cost of traditional first-time adoption. Some people argue that it will decrease the transparency or the quality of the financial statements because of less industry guidance, because of less disclosures, because of all these differences. The next staff report I'm going to talk about relates to a comparison between IFRS and US GAAP. The objective is to contribute to the execution of the work plan, present observations regarding the application in the IFRS practice. So basically what SEC staff did is that they took a lot of international companies where the companies had sophisticated accounting departments, looked at their IFRS financial statements, and tried to draw some conclusions based on reading those and how compliant they are with IFRS, and draw some conclusions regarding industries and certain geographical regions. So basically, their main comments are that financial statements were generally in compliance with IFRS. However, they also noted an interesting thing, that there were some former and current SEC registrants in the pool of companies, and the number of deviations from IFRS or potential deviations was a lot smaller in case of those companies that were previously or currently registered at the SEC. And they were focusing on transparency, clarity of disclosures that could be enhanced of certain situations, diversity of IFRS application, and there's a few reasons for that. One of them that they mentioned is that IFRS allows some alternative methods of accounting. In certain instances, it's not straightforward that you have to follow a certain route. It allows specific ways of treating certain accounting questions. And the other thing is that, as I said, it lacks some industry-specific guidance. It's more principles-based, and that caused some differences in the pool of companies. For example, they took a similar brand, an intangible asset, for 3 of the companies, and noted that the amortization period was completely different for all 3, even though the underlying asset was very similar. Or another example was that in case of revenue recognition, they were able to find some very significant differences, even though the underlying companies and transactions were similar, just based on the fact that there was no industry-specific guidance under IFRS. And there's another factor we have to consider, that IFRS is applied in several countries across the world, and the regulatory framework or the previous Gaap is significantly different in these countries. So management or the accounting team might still tie back to their previous Gaap just based on their experience or local requirements, which would obviously drive some differences in the application of IFRS, even though there is this general standard setting process. The last staff report I'm going to talk about relates to the comparison of IFRS and US Gaap, and the staff really just did a very high-level comparison. They really stayed on the principles level. It's worth reading this report. It's available on the SEC website. It's about a 2-page report. But they are not diving into a lot of details. For example, for shared-based payments, they are noting that the standards under US Gaap and IFRS are similar. However, if you go into the detail, you will find some significant differences. And they are just reiterating those couple of differences that we were earlier talking about, as well as focusing on the difference in authority level under the two standards. With that being said, I'm going to switch to the next topic. Just ties back a little bit to the previous staff report we were talking about. The report was prepared as of 1/1/10, but they updated with certain changes because there were some significant changes in IFRS due to the convergence project in the time in between. One of these significant changes was the revision of the employee benefit standard under IFRS. That was one of the original 11 standards, and it's going to be effective from 2013. So basically what happened here is that the standard setters wanted to align the IFRS treatment more closely to US Gaap, and they, among other changes, the two most significant changes were that they eliminated the potential application of the actuarial gains and losses, the corridor method of capitalizing actuarial gains and losses, and the past service cost or prior service cost under US Gaap. So basically what actuarial gains and losses are, there are changes in actuarial assumptions from year to year, mortality rate, discount factors, and under IFRS you can either expense it in the P&L immediately, or you can capitalize it on the balance sheet and amortize it based on the corridor method. Well, they took that option out. Just tying back to my previous sentence, that IFRS allowed some alternative treatments. This was, for example, one of them, and it can cause very significant fluctuation in the P&L of a certain company, depending on which route a company would choose. So, with that change, a lot of practical implications came out, and really, as a professional firm at Kpmg, these type of changes create a lot of challenges as well as a lot of opportunities for us, both in the advisory and in the accounting practice, to serve our clients and help them go through these hurdles, go through these challenges in this very quickly changing accounting environment. So I just listed a few practical implications. I'm not going to go into a lot of detail in these, but we can see that there's a lot of changes in terms of accounting and financial reporting impacts, the processes of the company. A lot of new disclosures are required, which may mean additional research in existing standards and upcoming standards. The company may need to hire new professionals, there are a lot of changes impacting the financial statements. And based on those, the business decisions the company is making as well. Human resources, again, the accounting department. And just based on this example, I'd like to share with you a professional experience of mine. When I was a second year with Kpmg, I had the chance to work on a first-time adoption of IFRS. I never worked on IFRS job before. In my first year, it was all statutory audit, and it was such a great opportunity for me to have the chance to work on the first-time adoption financial statements of the company. This was in 2006, and we had to go back for 3 years to establish the IFRS balance sheets of the company, translated from Hungarian Gaap, and it was such a great experience for me. I had the chance to work with one of the greatest IFRS experts in the country. I really learned a lot, and that I was able to capitalize in my later career. So again, at Kpmg, that's a really good opportunity, and even for second year people to learn more and serve our clients. And in case of this client, they didn't have a very sophisticated accounting department. They were really not prepared for the change. Therefore, our work, what we did, incorporated a significant element of advisory services and how they should deal with certain type of transactions. And obviously, it was a huge learning experience for me. So a little introduction about us. Just a few facts about Kpmg. As you all know, it's an international accounting firm present in almost all of the countries of the world with a huge international network. Over 700 cities and